So, everyone's popping the champagne over silver's recent highs, right? They're looking at silver touching incredible levels, like that run to around $121 an ounce back in January, and thinking the party will never end. But what if I told you they're missing the massive, flashing red signals in the latest Federal Reserve minutes? I think the party is coming to an abrupt end. And today, I'm breaking down the data that suggests a 20% correction isn't just possible, it's highly probable. We're going to hit three critical points that the mainstream story is completely ignoring. First, we'll look at the Fed's hidden declaration of war on inflation, tucked away in their latest meeting minutes. This isn't just a higher for longer story anymore. Second, we're going to analyze the changing situation in the Middle East. The massive geopolitical risk premium that has been propping up precious metals is evaporating. The talks in Islamabad, whether they ultimately succeed or fail, have already changed the game. And third, we'll look at the charts, because the charts don't lie. They're telling a story that the smart money is quietly slipping out the back door, leaving retail investors to hold the bag. We'll pinpoint the key levels that, once broken, could set off a chain reaction of selling. Stick with me, because what you're about to hear is definitely a contrarian view, but it's backed by the same data the big market movers are watching. This isn't about spreading fear, it's a reality check. Let's get into it. All right, let's start with the 800-pound gorilla in the room, the Fed. We just got the minutes from their March meeting. And to put it bluntly, it was a bloodbath for anyone expecting a dovish pivot. The decision to hold rates at 3.50% to 3.75% was no surprise. But the details buried inside were something else entirely. The vote showed strong consensus, but that's not the real story. The real kicker is that a vast majority of Fed members are now on record saying that progress towards their 2% inflation target has slowed down. Think about what that means. For months, the market has been pricing in rate cuts based on the assumption that inflation was yesterday's problem. The Fed just yanked the rug out from under that whole idea, but it gets much, much worse. Get this. The number of Fed members projecting zero rate cuts in 2026 has jumped. 7 of the 19 members now see rates staying exactly where they are. This isn't just a pause, it feels like a hawkish rebellion is brewing inside the FOMC. They're genuinely worried about sticky inflation. And the final nail in the coffin? For the first time in a long time, some members are openly talking about the potential for future rate hikes. Let me say that again. After years of stimulus, rate hikes are now back on the table. This is a monumental shift. So, how does this directly hammer the price of silver? It comes down to two things: opportunity cost and the US dollar. Opportunity cost is simple. Silver pays you nothing to hold it. When interest rates are high, investors can get a nice, risk-free return from government bonds. Why would a big fund park billions in a non-yielding metal when they can get a guaranteed 3.75% or more from Uncle Sam? A hawkish Fed makes holding silver incredibly expensive. Then there's the dollar. Silver is priced in dollars. When the dollar gets stronger, it takes fewer dollars to buy an ounce of silver, so the price of silver falls. A hawkish Fed is like rocket fuel for the US dollar. As other central banks might be looking to ease, the Fed's tough stance makes the dollar the most attractive currency out there. We're already seeing money flow into the dollar, not because of war, but because the Fed is seen as the only adult in the room. Remember that brutal 20% drop silver took in a single month recently? That wasn't random. That was the market waking up to reality. The March minutes didn't just confirm this, they poured gasoline on the fire. Anyone ignoring this is driving with a blindfold on. The second major pillar holding up the silver price has been the fear of a wider war in the Middle East. For months, the market has been baking in a risk premium. Every headline about the Strait of Hormuz, every threat, every rumor added dollars to safe haven assets like silver. At its peak, this fear helped push oil towards an inflationary $110 a barrel, making hard assets look even more attractive. We just saw how sensitive the market is. On the news of a potential ceasefire, silver spiked to nearly $78 an ounce before that hope fizzled out. That knee-jerk reaction shows you just how much of the price was tied directly to war speculation. That premium is now rapidly disappearing. The US-Iran talks in Islamabad, brokered by Pakistan, have fundamentally changed the dynamic. Now, the talks have been tough and just broke down without a resolution. But here's what the market cares about. Direct, high-level engagement is happening. That's a world away from open conflict. Just sitting at the table, even if you walk away angry, lowers the perceived risk of an all-out war. The market is a forward-looking machine. It doesn't wait for a treaty to be signed. It reprices risk in real time. The war premium that was so powerful is now being unwound. Traders who bought silver as a hedge against a Middle East blow-up are now selling. Why? Because the worst-case scenario is no longer the base-case scenario. The story has shifted from imminent war to a difficult diplomatic slog. And diplomacy, even when it's failing, is bearish for war premiums. This also has another effect that's bad for silver. It strengthens the US dollar. Global investors are choosing safety and liquidity over hard assets. This creates a perfect storm. On one hand, the chaos hedge is shrinking. On the other, de-escalation is boosting the currency silver is priced against. The tailwind has turned into a headwind. This is a key reason we see a 20% correction coming as silver adjusts to a world of fundamentals. Fundamentals tell you the why, but the charts tell you the now. And right now, the technical picture for silver is flashing multiple warning signs. Let's start with the big picture. After hitting that spectacular all-time high of around $121 back in January, silver has been in a clear downtrend. The recent rally attempt, which pushed silver up towards that $78 mark, failed spectacularly. From a charting perspective, this failure is huge. It created what's known as a bearish divergence. While the price made a new short-term high, indicators like the RSI failed to do the same. This is a classic signal that buying pressure is exhausted. It's like a car engine sputtering and losing power right as it tries to climb a steep hill. The bulls gave it their best shot, and they were rejected. That suggests the sellers are now in control. Even worse, we've sliced through support. The 50-day moving average, a key line in the sand for traders, was decisively broken. We saw a similar breakdown in the gold market. When both monetary metals break key technical levels together, it's a powerful confirmation that the selling is broad and systemic. These breaks often trigger automated selling programs, which can pour fuel on the fire. Now let's talk about one of the most important metrics, the gold to silver ratio. This simply tells you how many ounces of silver it takes to buy 1 ounce of gold. When it's rising, it means gold is outperforming silver. For much of the recent run-up, the ratio was falling. Now that trend has reversed. The gold to silver ratio is starting to climb. It tells us that silver is now the weaker of the two metals. Silver has higher volatility. It acts as a leverage play on gold. It falls much harder. So where is the price headed? When you look at the chart, the failure at $78 and the break of support in the mid-70s opens up a whole lot of empty space below. The next major structural support level isn't until you get down to the area around $63. From the current price of roughly $75, a drop to $63 is a correction of about 16 to 17%, putting us right in the ballpark of our 20% target. A break below $70 would likely be a psychological blow that accelerates the slide. The charts aren't a crystal ball, but they are a map. Right now, that map is showing a clear path of least resistance to the downside. Now I can already hear the comments. But what about the incredibly bullish long-term fundamentals? What about the supply deficit for 2026? What about solar and EVs? The industrial demand is real, and the supply deficit is real, but those are slow-moving forces. In the short to medium term, they're no match for a Fed that has its back against the wall and is coming out swinging. The bulls are walking into a trap, thinking history will repeat itself. They see a price drop and assume it's a buying opportunity, but they're failing to recognize the fundamental shift in the policy environment. So why is this time different? Why am I arguing that this isn't a dip to be bought, but the start of a much deeper correction? This isn't just another dip, it's a regime change. And in this new regime, the path of least resistance for silver is lower. They are desperate to cut rates to support a slowing economy, but they cannot risk reigniting inflation, which is proving far stickier. Thanks in part to those energy prices we talked about. In past cycles, the Fed could cut rates, confident that inflation was under control. Today, any signal of a premature dovish pivot could cause commodity prices to explode higher, undoing all their hard work. So they are forced to maintain a hawkish stance, even if it means inflicting some economic pain. They are putting inflation fighting above everything else. This is what makes it different. The historical tendency assumed the Fed would eventually pivot. The market is now being forced to price in a scenario where that pivot is delayed indefinitely. The chance of rate cuts in 2026 is fading fast, and the probability of rate hikes is no longer zero. This creates a long period of high opportunity cost and sustained dollar strength that will weigh on silver like an anchor. The industrial demand is real, but those are slow-moving forces. By the way, if you're finding this analysis valuable, do me a favor and hit that subscribe button and the notification bell. It really helps the channel. Okay, let's bring it all together. We've laid out a three-part case for why silver looks like it's heading for a major correction. First, the Fed is far more hawkish than expected. The environment of high opportunity cost and a strong dollar is here to stay. Second, the geopolitical fear premium is deflating. The shift from open conflict in the Middle East to tense negotiations has lowered the perceived risk, and that safety money is flowing out of silver. And third, the technicals are screaming bearish. The failed rally and broken support point to a move down to major support in the low 60s. What does this mean for you? it means now is a time for caution, not for chasing highs. A 20% drop would take the silver price from the mid-70s down to around $60. It means that starting a new long position here is fighting the Fed, fighting the charts, and fighting the unwinding of geopolitical fear. That's a low probability trade. The key events to watch are the next FOMC meeting on April 29th and the upcoming PCE inflation data. Any hot inflation number will be the catalyst. This doesn't mean the long-term bull case for silver is dead. The structural supply deficits and industrial demand are powerful forces. But in investing, timing is critical, and right now, the powerful short to medium-term forces are all aligned against silver. I want to leave you with a question for the comments. At what price would you consider this correction to be over? Is it 65? $60? I'm genuinely curious. If you want to stay ahead of these market shifts, make sure you subscribe and click the bell. We'll be tracking this closely. And as always, a final reminder, this video is for informational purposes only. Always do your own research. Thanks for watching.